The financial condition of the United States just continues to get progressively worse. This week, a new wave of bad news triggered panic in the markets as consumer prices and living expenses recorded another spike. Meanwhile, business and household debt soared to unprecedented levels. Bankruptcies started ticking back up. The number of foreclosures exploded, and more Americans are reportedly becoming uncomfortable with their ability to pay their mortgage loans. In essence, each and every long and short-term trend is showing that the financial health of U.S. consumers and businesses is sharply declining. That's why today we've decided to compile the latest numbers that expose America's terrible financial condition. But before checking this list, please support us by leaving a thumbs up and subscribing to our channel so you don't miss our upcoming lists. Without further ado, here are 20 numbers that prove that America's current financial condition is a horror show. 1. Markets are in panic today after the latest reading of the Consumer Price Index was released by the Bureau of Labor Statistics. The inflation rate for the month of May was significantly higher than the Wall Street consensus estimate of 8.2% and even broke the March record, jumping by 8.6%, marking the fastest increase since December 1981. Pushing the index higher, energy prices jumped by 3.9% from a month ago, bringing the annual gain to 34.6%. In addition, fuel costs posted a 16.9% monthly gain, pushing the 12-month surge to 106.7%. It's hard to look at May's inflation data and not be disappointed, said Morning Consult Chief Economist John Lear. We're just not yet seeing any signs that we're in the clear. 2. The inflation news consequently led all the three major stock benchmarks to close sharply lower. Today, the Nasdaq Composite suffered the biggest loss, dropping by almost 3% as investors worry about slowing economic growth, while the S&P 500 slid 2.4%, with all of its sectors closing in negative territory. And the Dow Jones fell by almost 700 points on Thursday and another 500 points this morning, according to preliminary FactSet data. 3. At the same time, higher inflation and escalating prices actually mean that workers are facing another pay cut. Even though hourly earnings rose 0.3% over the past month, real wages, when accounting for inflation, fell 0.6%. On a 12-month basis, this means that U.S. workers' real average hourly earnings dropped by 3%. 4. Americans' buying power has been steadily declining over the past few years. The national money supply has skyrocketed over the last 2 decades, up from $4.6 trillion in 2000 to $19.5 trillion in 2021. In fact, around 25% of all U.S. dollars in the money supply, $4.4 trillion, were created in the past 24 months. More money in circulation means that each dollar values less. For instance, $1 US could buy 10 bottles of beer in 1933. Today, it's the cost of a small McDonald's coffee. 5. On top of coping with a shrinking buying power, the net worth of U.S. households is going down, while household debt is shooting up. According to the Fed's quarterly financial accounts, the net worth of households declined by $500 billion in the first quarter. In contrast, household debt hit $18.3 trillion during the same period. That is the highest level on record. 6. Given that living expenses are still ticking up, U.S. consumers have been taking on more and more debt. According to a separate report from the Federal Reserve Bank of New York, revolving credit card debt rose to $841 billion in the first 3 months of 2022 and is expected to keep heading higher. But as the central bank continues to raise rates, carrying a balance month after month will soon cost even more than it does now. 7. This week, bad news didn't stop coming. The latest data shows that total student loan debt has surpassed $1.75 trillion for the first time ever. This means that the average student loan debt at graduation has increased by 2,807% since 1970. From 2018 to 2022, the student debt load skyrocketed by $250 billion. 8. At this point, U.S. consumers are seeing their financial conditions worsen month after month. In May, official numbers exposed that Americans are saving less, with the savings rate dropping by 4.4%, hitting the lowest level since 2008. Conversely, Americans are borrowing more. The number of loans rose by 7.5% last month, marking the largest increase since 2011. 9. Mortgage delinquencies are also on the rise. The median home prices soared 30% over the past 2 years to $428,700, according to census data. And as mortgage rates rise above 5.3%, fewer homeowners can afford to pay their mortgage loans. Last month, the national delinquency rate rose for the first time in 9 months. The number of properties that are 30 or more days past due reached approximately 1.95 million nationwide. 10. Moreover, Black Knight data shows that the number of foreclosures is also soaring. In May, the total number of U.S. foreclosures hit 25,000. That is a shocking 541% jump from the same time last year. 11. Meanwhile, the Fed's quarterly financial accounts report also found that business debt grew at a rate of 8% in the first quarter of 2022, reflecting strong growth in loans issued by private lenders and a 14.9% surge in the number of loans issued by federal agencies. 12. Right now, roughly 48% of U.S. small businesses are extremely concerned about the financial impact of rising inflation. According to Capital One survey, 71% of small business owners indicated that inflation has had a negative impact on their business in the past year, and 77% are worried about lasting impacts. 13. On a similar note, the Bank of America Small Business Owner Report uncovered that 68% of small businesses plan to raise prices this year, as nearly 9 out of 10, 88% in fact, can't keep up with the pace of rising operational costs. 14. Even more worryingly, bankruptcy filings are creeping back up. The total number of new commercial and consumer bankruptcies grew by 33.5% in March over the prior month, according to the latest data released by Epic, with consumer filings increasing by 34% and commercial cases jumping by 26%. 15. The U.S. trade deficit is getting wider and wider. The latest available data shows that the U.S. monthly trade deficit increased by $20 billion to $109.8 billion in the first 3 months of 2022, reflecting a surge in imports as companies relied on foreign producers to meet domestic demand. The gap in goods and services trade grew 22.3%, Commerce Department data revealed. In the first quarter, the widening of the trade deficit largely explains the economy's worst performance since the pandemic recovery, with gross domestic product declining. That's because the value of products American businesses and consumers bought from overseas outpaced purchases of U.S. goods and services by other economies. 16. On an annual basis, the total trade deficit was $859.1 billion, according to the BEA, the U.S. Bureau of Economic Analysis. The U.S. imported $3.4 trillion in goods and services. That's an increase of $576.5 billion. Exports were at $2.5 trillion. marking a $394 billion increase from the previous year. We're on track to record a $1 trillion trade deficit this year, according to Goldman Sachs estimates. 17. In a new Wall Street Journal NORC poll, 35% of Americans said they were not satisfied at all with their present financial situation, the highest level of dissatisfaction recorded since the poll began in 1972. 18. Similarly, Morning Consult recently conducted a national survey of 1,600 employed adults to evaluate their financial difficulties and measure workers' access to emergency funds, underscoring Americans' financial fragility. The survey pointed out that 42% of employed Americans feel very financially insecure, and a quarter, 24%, report having zero savings set aside for unexpected expenses. A third, about 33% of working adults, feel uncomfortable about their ability to pay for a $400 emergency expense, and nearly 1 in 10, 8%, would not be able to afford it at all. 19. The survey also highlighted that nearly 4 in 10 employed adults, around 39%, say they've struggled to pay for personal expenses over the past 12 months, including the 27% who report difficulty on at least a monthly basis. 20. And it seems like many more loan delinquencies will occur this year. According to Deloitte's State of the Consumer Tracker, the percentage of Americans concerned about making upcoming payments hit 35% in May. That is the highest this metric has reached in 2 years. These numbers are proof that the system is seriously broken. The United States is now witnessing the growth of a massive debt bubble that threatens the financial future of the entire nation. Unfortunately, anyone out there who still believes that the U.S. economy is somehow headed for progress is completely mistaken. Nothing has been fixed in our economy in the past few decades. Instead, our long-term financial imbalances are getting worse at an escalating pace. We're actually on the verge of another financial disaster. And from this point on, the downfall is only going to accelerate. We thank you for watching this report. Please share it with family and friends and subscribe to our channel.